This video will cover background material for interest rates. I'll start off with the idea that an interest rate is the opportunity cost of money. So if you're holding money in your pocket right now, there's an opportunity cost associated with that. It's the interest rate that you could get on that money. So if you're holding cash in your pocket, the opportunity cost of that money is the return. In other words, the interest rate that you can get on the next best alternative use of that money. If that money could be deposited in a money market account at a bank earning 3% per year, that's your opportunity cost. The idea of opportunity cost of money is not new to you. It was covered in Chapter 5. Yeah, that's right. There's a short story in Chapter 5 that basically says, look, you're considering buying a bond, and you're not really sure what the rate of return you should earn from that bond should be. And at the same time, the bank offers you 5% on a CD with similar risk, and that's key, with similar risk as the bond. So you're contemplating buying this bond, and you're trying to figure out, well, what kind of rate of return should I earn from it? In other words, what should the discount rate be on this bond? Well, you don't have to go too far. You already have the answer. Since the bond and the CD have the same risk, the interest rate on the CD should be the same as the interest rate on the bond. Therefore, you should discount the bond at 5%. Because the CD represents the opportunity cost associated with buying that bond. So formally, the opportunity cost is the rate of return that you could or would earn on an alternative investment, such as the CD. Moving right along, we're going to look at the price of money, which again is an interest rate. So when you rent money, so to speak, you have to pay an interest rate over the period of time that you're renting that money. And so when you're dealing with interest rates, you're really at the intersection between finance and economics. Therefore, we're going to look at the supply and demand for money, where the price of money is the interest rate on the y-axis. Normally, you're used to looking at the price of a good, say, on the y-axis, P. But now we're going to have an interest rate on that y-axis. So let me show you with some pencil and paper. So now, before we actually get into a supply and demand diagram, let's look at the shifters. What are the shifters of supply and demand? In other words, what are the factors that drive interest rates? And those factors will be production opportunities, time preference for consumption, risk, and inflation. And I should highlight expected inflation. In other words, inflation in the future. So let's start with production opportunities. It's a fancy term for basically saying, look, if there is a lot of activity in the world, in the business world, and there's a lot of demand for money to invest in projects. So look, people go to banks, they go to the financial markets to borrow money, and they invest it in property, plant, and equipment and projects in order to produce goods and services and make a profit. And so when production opportunities increase, in other words, the economy gets stronger and there's a lot of demand for money, well, there I just said it. Production opportunities go up, it means demand for money is going to go up. And I'll show you that in a second. The next term here that we see is time preference for consumption. Now that looks really strange. And it might be reminiscent of what you learned in economics. And I'm not assuming you have any background in economics. We're starting from scratch basically in this course when it comes to the economic component. But time preference for consumption basically means, look, when do you want to buy goods and services? Would you rather buy them now? And that's the time component. What are your preferences and timing of when you want to buy? Because when you buy, the assumption is you're going to consume the good. So if you're in a hurry to buy something and consume it, then you're not going to save very much money. And if you're not saving much, well, savings is the supply of money. And so, okay, that's going to affect the supply curve. Now, if you're very, very patient and you're not interested in consuming much and you want to save for, say, a rainy day or the future or retirement, for example, then your preference for money is not that high right now. You prefer to have your money later, in which case you'll increase your savings, which will increase the supply of money out there in the economy. Now, the other factor here that we're going to look at is risk. And risk has to do with how risky, how volatile is the cash flow going to come off of the various projects that are out there, that people are going to take their money and invest it. So this is from a saver's perspective. the higher the risk that you're going to lend your money to or invest in something, the higher the rate of return that you will demand. That's a big component of this course. I'll say it again. The higher the risk that you expect a project, that you expect an investment to have, the higher the expected return that you're going to want from it. That just means you're risk adverse. You're nervous about risk. So you're not going to part with your money unless you get a good risk premium. And so that's going to affect the supply curve, because savers are going to want a high rate of return if there's risk. That means all else being equal, if you see high risk, then the supply curve is going to shift off to the left to get that higher interest rate. And I'll show you that in a second. Now, the fourth component here is inflation, expected inflation. What do you expect inflation to be like in the future? Expected inflation actually shifts and can move both curves, the supply and demand curve. So when expected inflation goes up, you'll see that interest rates go up. That means supply curve is going to shift up and to the left, and the demand curve is going to shift out to the right. Now, when inflation goes up, savers are going to want an inflation premium for their return. And that's what's shifting the supply curve up and to the left, thereby reducing supply. Borrowers now, if they see higher inflation, all else being equal, they're going to want to demand more money today. So they want to borrow more money today. It means demand is increasing. And why is demand increasing? Why would you want to borrow more money today if you expect inflation to go up, all else being equal? Important caveat there is because, well, your income and your salary over the future will increase at the rate of inflation, but you will have borrowed a fixed amount in the past, which will be relatively smaller than what it would be otherwise. And so you've borrowed this fixed amount, and the economy has inflation, prices are going up, your income is going up. It's easier for you to pay off that loan now with an inflated income or an inflated salary. So now I've kind of danced around the supply and demand curve. Let's actually draw it as it relates to these categories. Admittedly, what I just said over the past few minutes is kind of vague. Let me try to drive it home by actually building out a supply and demand diagram like this. So here is the interest rate. Just call it, label it R, it's percent. Here is the amount of money, the quantity of money. So this is the price of money. So this is Q, quantity, and this is P. Just like when you saw in economics, you had, the price of fish and the pounds or quantity of fish here. We're going to do it with money. It's a little more abstract, and you, like I said before, you probably haven't seen this in an economics course. So now we have a demand curve and a supply curve, and we have an intersection where supply equals demand, and so this is the quantity of money demanded, and this is the price. An interest rate, let's say it's 3% to put a number to it. Now let's make sure we're comfortable with how these supply and demand diagrams work. Just like in economics, when you change this axis, when you change something on the axis, specifically this y-axis, and you change the interest rate R, then you're going to move along the demand curve. So what this says is, look, we have an upward sloping demand curve, and when interest rates rise, the quantity of money demanded drops off. We move off in this direction as interest rates go up. So that's why it has a downward slope. So when interest rates are low and we're down here, there's a lot of money demanded because money is cheap. Now, from a supply perspective, this is savers. Think of it as savers here. And say, think about it. You have money. Wouldn't you like to earn a really high rate of return up here where you get a high rate of return, right? A lot of people would want the same thing. And so they're going to be supplying a lot of dollars. So when interest rates are high, you start increasing, you're going to get more savings and more supply. When interest rates are low, you're moving down in this direction. Interest rates are low, quantity of money supplied is low. There's going to be an equilibrium. How do you know it's an equilibrium? Well, if you have an interest rate that's above right here, then that means supply is greater than demand. And when supply is greater than demand, that's a surplus. When you have surplus, it kind of drives the price down. It drives the price down here. until you're right at this point, and now there's no surplus. If you start out with an interest rate down here, then that means you have excess demand. You have a shortage relative to supply. And you know when you have shortages, prices go up, and you're right back here. So you end up with an equilibrium at this point. So that's where we start off. We start off in equilibrium. So now let's talk about production opportunities. Production opportunities increases the demand for money, and so it's going to be a shifter of this demand curve. We're not changing R. If we're changing R, we'd move along this demand curve, but we're not changing R. We're changing something else. And in fact, I'm saying production opportunities increased, and this demand curve will shift up to the right. Interest rates will rise. Interest rates will rise because the quantity demanded of money just went up. Businesses are ramping up production and they need to borrow money. They could borrow money for inventory purposes, to increase their property, plant, and equipment, all to build out production so that they can be prepared for an increase in demand in the future. And you'll be at a new equilibrium, let's say right here. Now, let's move on to time preferences. When time preferences for consumption go up, meaning that you want to consume right now, that means you as a saver, you don't want to save. In fact, you'll draw down your savings, and that's not started off by a change in R. That's because you changed your preferences as to what you wanted to buy at a point in time. And so if you prefer to consume now rather than later, you're not going to save as much. And not only that, you could even draw down your savings. It's going to shift the supply curve to the left. And there's going to be less supplied, less money supplied, so interest rates are going to go up. Now, the third thing was risk. And we always look at risk from a saver's perspective because savers have to part with their money. They're not going to part with their money unless they get a good high rate of return if it's risky. The less risk, the less return that people demand. And that's going to be a story that you're going to hear throughout this course. Now, if risk goes up, that means all else being equal, this interest rate is going to go up this way. Savings is going to be reduced, all else being equal, when risk goes up. And what that means is a higher interest rate to compensate savers for that higher risk. Now, the fourth factor that can shift interest rates is expected future inflation. When future inflation goes up, two things happen, remember. Now, it's going to be shifting both the supply and the demand curves. And so demand goes up. Why? Because people would want to borrow money. They'll rather borrow money now and then get locked into a low fixed rate and then have to pay that money off with their inflated income over time. And so all else being equal, people will demand more money knowing that expected inflation will go up. Savers are going to look at it from the opposite perspective. They're going to want to shift their supply curve to the left if inflation's going up because they're going to get paid off in inflated dollars. The money that they're getting is not going to be worth that much. So savers are going to be hesitant. They're going to want a high rate of interest to offset that higher inflation. And so that's going to push your supply curve up. So what happens here is, and let me get another color, let me get green. What's going to happen is you're going to have a demand curve that shifts out to the right, and then you're going to have a supply curve that shifts out and to the left. Call that supply. So we get a new equilibrium interest rate here. Whether or not quantity goes up or down is another story. The change in the equilibrium quantity demanded is ambiguous, as we don't know which shifted more, the demand curve or the supply curve. But for sure, you're going to see higher interest rates. And by the way, one more thing. This interest rate here is what's often called a nominal interest rate. It's a quoted interest rate. It's the interest rate that you would get if you go into a bank and you want to buy a certificate of deposit or you want to get a loan and you ask, what is the rate? That's the rate they're going to give you. You look in the financial section on a website and you're going to see bond quotes and yields. It's going to be almost always a nominal yield, as opposed to what's called real yields, which we'll talk about a little later, real interest rates. That's what we're going to talk about later in this chapter. So there you go, a supply and demand schedule for money that leads to an interest rate where changes in production opportunities, time preference for consumption, risk, and expected inflation are all related to that diagram. A bit more than what's spelled out in the textbook, I admit, but it gives you a little deeper insight on how these four factors drive interest rates using that supply and demand diagram. Now what I want to do is look at how the business cycle influences interest rates. The textbook discusses this in passing, not very detailed. Let me talk about it just for a few minutes before we slide back into the supply and demand diagram. Interestingly, it turns out that the business cycle is very important for interest rates, and if it's really important for interest rates, it's going to be very important for bond prices, and it's going to be a very important determinant of stock prices, concepts that are going to come up in the next couple of chapters. So there's, again, that intersection between the economy and interest rates, and therefore the economy and stock and bond prices. So let me show you what we mean by the business cycle. Let me give you a convenient representation of what the economy looks like. So let me show you a simplified version of what the economy looks like over time. Imagine this wavy line as gross domestic product. In other words, the value of all goods and services produced in the economy for a given year. In other words, to measure the size of the economy. Or personal income for the entire country. And this axis is time. The economy grows over time. It's obviously not this smooth, but it's convenient to represent it this way. And so when we're in periods around here, we're above this average, the economy is doing very, very well. We're in an economic boom. But what often happens is we end up in recessions where we have unemployment, and then we go into booms again, and then we go into unemployment. See, the economy goes in and out of economic booms and recessions. That's basically the economic history of the United States over centuries, and many other countries around the world. They go into booms and recessions periodically. And the important point here is that we want to relate this to interest rates. It turns out when the economy is really strong, prices tend to go up. We tend to get shortages, especially in labor, and the price of labor is wages, so wages start to go up, and that factors into income statements for companies, and then so companies end up raising prices to keep their profit margins in line. And so when you start having a strong economy, you run into various shortages, labor, products, wood, lumber, for example, housing tends to start to go up, and you get inflation. So there you see it. When you go into an economic boom, you tend to have higher inflation or rising inflation. And then when you go into a recession, the economy slows down, unemployment increases. There's less pressure on wages to go up. Prices tend to drop, especially, for example, oil prices tend to decline, and we go down here. So you have high inflation, and then you have low inflation. In fact, you can actually have negative inflation at times. So that connects the business cycle to expected inflation. We can also connect it to production opportunities, because when the economy is really strong, there's heavy demand out there. Consumers are buying a lot of things. Businesses and individuals are investing in property, plant, and equipment. So there's a lot of demand. That means there's got to be a supply side to things, and that's exactly what businesses do. Their production opportunities ramp up. So the various projects that they were contemplating doing maybe when they were in a recession, they just weren't profitable at that time because there wasn't heavy enough demand. Well, when the economy gets much stronger, that demand comes into play. Those projects now make a lot of sense. They're profitable. And so production opportunities increase, and the demand for money goes up at this point. Demand for money goes up, interest rates go up. So what happens is, inevitably, we have an increase in interest rates in an economic boom, and we tend to have a decline in interest rates as we head into an economic recession. And so there's a heavy business cycle component to interest rates. Now, there's there's two things that were left out of this introductory video and in the textbook introducing the concept of interest rates. And the two biggies are, it doesn't discuss the implications of the federal government. So when the federal government runs deficits and it has to borrow from the public, and it issues bonds, as we'll talk about in a later chapter, what that means is there's really heavy demand for money by the government. The government wants to borrow money to finance its operations. And so that pushes interest rates up. In addition, The borrowing by the federal government tends to have a business cycle component to it because especially when we go into recessions, like when we hit COVID, for example, there was lots of spending by the federal government, and the federal government spent that money. Where did it get it all? Well, it borrowed it in the markets. So there tends to be a business cycle component to the government's borrowing. So the federal government has a hand in this business cycle also. And that wasn't mentioned. The other thing that wasn't mentioned is the Federal Reserve. The Federal Reserve often is the source of the drop in interest rates. So you get into this really strong economic boom, and the Federal Reserve, is concerned about inflation. And what it does is it raises interest rates on its own to try to slow the economy down. And that can often be a source of this recession. So near the top of a boom, interest rates start to go up here. And when the interest rate goes up here, it slows the economy and you go into a recession. That is discussed much deeper in a course called Markets and Institutions, where we talk about the Fed and the banking system and their influence on interest rates. Now that you have a better handle on the supply and demand for money, and the price of money is the interest rate, and here we have the quantity of money on the x-axis, we can get a little more intuition as it relates to this course. Later in this course, we're going to be looking at investing in projects. Managers, financial managers of a company, often have to contemplate and decide on, which projects should we invest in. We got like 10 different projects we could invest in. How do we go about doing that and analyzing it? Well, it's a subject that pops up towards the end of the course. But I can relate it to this supply and demand diagram pretty easily. So here we go. Let's assume this is a supply and demand diagram. Let's just put a number here, 3%. And let's put in here, let's just put in $10 trillion right here, just to make up numbers. Now, what I want to do here is show you that, look, there are corporations that want to borrow money, and they want to borrow that money to finance projects. Now, they're demanders. Firms are demanders of this money, and individuals will think of it as individuals saving here. And so first off, what you need to realize is that the market is going to be right here at $10 trillion. And any activity beyond 10 trillion won't happen. So here's what I mean. If you run a firm and you have a business and you have some really profitable projects, then you're willing to borrow at a really high rate of return. You're willing to demand funds at, maybe 10% right here. And so there'll be a few firms that do that. So the quantity of money here in those terms will be kind of small. And then there'll be some firms that, maybe 9% is really good because they have really good, attractive projects that they want to take this money and invest it in. And if you keep going and you keep going and you keep going, and finally you get down to 3% here, well, there's some firms that are right on the borderline of 3%. They're indifferent as to whether or not they want to borrow money because their projects are kind of okay. Now, if they have projects that are going to earn a low rate of return, these businesses, they'll want to borrow at a really low rate of return also. So if you have a project that's only going to earn about 2%, well, you're going to want to borrow at a low rate of return. So what I'm trying to say here is the equilibrium price of money is 3%. And firms that have projects that are going to earn more than 3%, excluding finance costs, they can afford to borrow at above a rate of 3%. And so these firms are going to borrow. They're going to get the money. They're going to borrow. These firms down here, they have projects that just don't earn enough money. And so it's not profitable. The interest expense is going to be so high, it's going to cost them money. In other words, they're going to lose money on the project if the interest rate is too high. So these are firms that just don't have projects that are very profitable. And these people will get the money, borrow it. Now let's look at it from a supply perspective. If you really want a high return on your savings, you'll want a return higher than 3%. You're going to be up here. You're going to want a really high rate of return up here, and you're just not going to get it. The equilibrium rate of return is 3%. In other words, the market is only offering 3%. Now, what if you wanted a lower rate of return down here? Oh yeah, you're going to be able to, that are willing to pay you 2%, 1%, or whatever here. In other words, the opportunity cost of money for these individuals is really low. They don't have any better alternative for their funds. So these savers, they're going to be able to save. These people are going to be able to save, and they're going to get a 3% rate of return. And these people here, these firms, are going to want to borrow money at a they want to borrow it, and they can borrow it above 3%, but the equilibrium rate, because you have all these businesses and all these individuals come together and meet together, and the interest rate is 3%. But there's going to be some firms that really are willing to pay a higher rate of return. They're going to get some benefit from paying 3%, and you're going to have savers that are really willing to earn lower rates of return, but since the market is 3%, they're going to get 3%. So they get benefit going into the market. Just keep in mind that it's the people on this side to the left of this supply and demand intersection that transact. In other words, they borrow and lend and make a market in money.